All right, my friends, let's do it on this Monday morning. Good morning, one and all. Welcome to The Street today, here from Post 35 on the floor of the New York Stock Exchange. Today is Monday, February 27th. It's already almost March. Welcome to almost March, folks. I'm your host, JD Dirk, and that's what the box says. We're about an hour or so into trading session. A lot of green here on the big board today as stocks try and bounce back after the worst week of the year that we've had in 2023, at least so far. Let's talk about what's on tap for this morning's broadcast. On the show today, we will talk markets as stocks come off their worst week of the year so far. Plus, we will tell you what to watch this week with retail earnings on deck. And finally, we'll tell you what exactly is going on with Twitter. Well, I should say, we'll try our best to tell you what's going on Twitter. No one actually knows, as the social media giant announces yet another round of layoffs, and some high-profile ones at that as well. For more on these stories and so much more, we now welcome in Mr. Martin Baccardax on this Monday morning. He is our senior editor, our chief markets correspondent, and most importantly, my friend. Hi, Martin. Good morning.
Kindest intro I think I've ever been associated with. My gratitude for that.
Listen, you know it, because we talk business, we're here to do work, but before we are employees who do work, we're just people, Martin, and you and I are friends. Let's talk stocks here, coming off two back-to-back weeks of declines, their worst week of the year so far last week. Give me your sense on either what dragged on investor sentiment heading into the close on Friday, or really, what are we seeing with regards to a bounce back so far?
It'll be interesting to see whether this bounce back can sustain some legs, JD, but I fear that it won't. We're up early, and it's reasonably solid, and we are seeing a pullback in Treasury bond yields, and I think all of those components are important. But I do think this week will be indicative of where stocks are headed. We're in for a very difficult March, I think, particularly if there are any indications that the Fed is going to become even more hawkish than it is. And there's 6 Fed speakers out in the field this week. So there's every chance that we're going to get some commentary that will lift Fed fund futures and therefore ultimately give us another bounce in Treasury yields. That's going to add further pressure on stocks. But at least for the moment, I think the broadest sentiment that we're seeing is that the economy, despite all assurances to the contrary, is holding up very, very well. The Atlanta Fed GDP forecast has first quarter growth growing at a 2.7% clip. There wasn't anybody that had that on their bingo card even a few weeks ago, let alone a few months ago. So I think as a result, people are just trying to do a straight line calculation by saying, listen, the economy is growing at this pace, then we have to see earnings advance alongside of it, because that's generally always the way it works. Now, the flip side of that is that higher interest rates are going to press down on stock valuations. We don't know who's going to win in that tug of war just yet, but today it seems investors are a little bit more optimistic about growth prospects, and as a result, they're filtering that in to their prices for stocks as a result of them seeing potentially better earnings growth.
2.7%, according to the Atlanta Fed, like you said, as of February 24th. Martin, that's not below trend growth, is it?
No, and this is exactly why, JD, we're hearing so much more about this no landing scenario for the U.S. economy. Just to put it into terms, the soft landing is generally when the Fed can engineer a slowing of the economy and a taming of the inflation, but a slowing that doesn't necessitate a recession. Now, a hard landing is one where inflation is cooled, but the economy has to fall into recession as a result, because the tightening is just so severe and has such implications for the job market and indeed for corporate investment. What we're seeing right now are at least some bets that there'll be no landing whatsoever, that the economy will carry on growing at this above trend rate with low unemployment whilst taming inflation at the same time. Because it has to be said, it's reasonably surprising, I think, to most, extraordinary to some, that the economy has been able to withstand these significant rate hikes. Now, the impact of last year's rate hikes have not filtered through into growth prospects just yet. But even considering that lag time, we are much more advanced in terms of growth than we ever thought we would be. And as a result, this is why we are hearing more and more about this no landing scenario.
I do want to ask you about bonds, if we can. The 2 years reached its highest level since July of 2007, at least earlier this morning. It was at about 4.83. The 10-year, however, last time I checked, was down around 3.91. That was around the time of the market open. which of course means prices of the long-term bonds are obviously higher given the inverse relationship. Are these further signs you think that investors are seeing those long-term bonds as safer places to put their money when compared to more traditional equities? How should we read the great ongoing imbalance? Is it ever one?
Yeah, there's no question about it. I mean, there's basically some circuit breakers along the way because, of course, as more money piles into fixed income in order to enjoy the higher yields, prices rise and the yields come down. So we can't always assume directional sort of narratives from what we're witnessing in the bond market on a day-to-day basis. It's something that you have to see sort of over a longer period of time. But that said, there's no question that the higher treasury bond yields are offering an attractive alternative to equity investors who might not be as excited about the risk prospects for markets as they were maybe just a few months ago. The S&P 500 dividend yield is about 1.65%. So even looking at a short-term two-year Treasury note yield at about 4.8%, that's more than double the S&P 500 dividend yield, and you get it for no risk whatsoever. You're protected on the downside, and you collect your coupon over the two-year maturity of the paper in question. So that really does offer a significant and competitive alternative to stocks. And you're seeing that played out in fund flows. Bank of America publishes a report each and every Friday called The Flow Show, which gives really detailed sort of figures on how and where money is moving around the world. U.S. equity funds saw $9 billion in outflow last week. That's the third consecutive week where cash was being pulled from equity funds by the biggest fund managers in the world. And we actually saw a continuation of money going into fixed income funds. And we've seen actually the longest 8-week stretch for fixed income inflows since November of 2021. So investors are sniffing out the higher returns and the low risk, and they're putting their clients' money into fixed income as a result. So that, if nothing else, JD, gives you an indication of the kind of competitive sort of returns that equities are fighting against at the moment.
Yeah, absolutely. The 2-year at 4.805, the 10-year at 3.926. So we'll continue to follow that one very closely. In terms of overall increasing volatility, Martin, where are we seeing volatility increasing, I wonder?
We're looking right now at the VIX. The last I saw it was around sort of 21 to 21 and a half points. There's a bit of arithmetic that you can run on that, but the simplest equation, JD, is to take that 21 and a half point VIX level and divide it by 16. Essentially, if you do that, you get a figure that represents roughly the percentage change on any given day for the S&P 500 over the next 30 days. And you can translate that percentage into points. So doing the rough arithmetic in my head, we divide 21 and a half by 16, we get about 1.35%, and that translates to somewhere in the region of 54 to 57 points, depending on where the S&P 500 is right now, and I can't see it, unfortunately. That's not immensely elevated levels of volatility, but it is moving in a higher direction, and we are getting to price levels that we saw at the beginning of this year. The Wall Street Journal actually published a report this morning that says CBOE data where the VIX is trading indicates that call option buyers are purchasing those options at the fastest pace in 2 years. What that means in layman's terms is that investors see volatility rising and they want to catch that rise before it accelerates. And that's exactly what we're seeing played out in those VIX call options and why we're seeing the VIX creep higher. Now, whether or not this sort of has an arithmetic sort of influence on the S&P 500 is a matter for debate. But nonetheless, it's a piece of information out there that almost all investors are wary of and use in terms of their directional trades on any given day. So it has to be respected, even though it isn't always a sort of beat for beat analysis, if you will. So as a result, people are bracing themselves for more volatility going into March. And it's another reason why so many people think March is a really vulnerable month with respect to S&P 500 performance.
The S&P 500, for the record, is exactly at 4,000 as we speak. By the end of the show, it may be off that number, but it's 4,000 and change as we speak. It's been around that level. It is up about 7/10 on the day. The Dow up 7/10. The tech-heavy Nasdaq up 8/10 as well. So some green on the board, but again, we wait and see after last week. Speaking of last week, Martin, we did get hotter than expected inflation data last week. We're starting to see the number, at least a few data points, start to trend not the way that people wanted to. Do you have any impact on the likelihood of a 50 basis point rate hike in March, according to CME Group FedWatch? Let's talk it.
It's only rising a little bit. It's been hovering at that 21 to 23% range for much of this morning, and indeed the latter part of the session on Friday. I just think that investors would like to entice people into that bet, but what they are hearing from the Fed is more about consecutive 25 basis point rate hikes rather than a, inverted commas, jumbo hike for the March meeting. But again, nonetheless, it is out there, and it does suggest that the Fed has the potential to become more hawkish in the coming weeks. I think the biggest concern, JD, linked to all that is the fact that the PCE inflation data from Friday was really heavily influenced by consumer spending. The consumer spending portion of that composite reading of the PCE price index rose at the fastest pace in about 2 years. That dovetails with the better than expected jobs numbers we saw for January. It dovetails into the much stronger than expected retail sales figures that we're seeing. And indeed, you could argue, also blends in the fact that the University of Michigan consumer sentiment figure is moving to the upside. So if that momentum can be maintained and indeed accelerated into February and possibly even in March, specifically in the job market, the Fed is going to get very worried because they've been saying for the longest time that the wage inflation connection is their most significant concern. In other words, if we are seeing so many people on the sidelines of the job market, which is reflected in the JOLTS data and the suggestion that 11 million positions remain unfilled, employers are going to have to pay more people to come into pay more for people to come into work. That's going to lift wages. Wages are going to feed into prices, and you get a sort of doom loop, if you will, with regards to CPI and PCE inflation. So we have to watch that with great interest. But I do think investors were worried about the dynamic of that PCE reading, and it is certainly part of the reason why we had such a significant pullback in stocks last week.
It's easier to keep spending money on $8 eggs when you are offered a job that pays you more than you made at the last job, right? I mean, that's basically what we're coming down to, right? Because if part of the goal here for the central bank is to limit the spending power of Americans in the day-to-day economy, but I mean, you really just highlighted the vicious cycle, I think, in a really good way. Those prices will stay high if people are like, oh, well, I feel pretty good about my job prospects. I can get another job that pays me. I'll spend that money on the eggs. Sorry to all the egg enthusiasts watching the show. This next part, yeah, go ahead. Anything on eggs? And are you an egg fan, I guess?
Yeah, you know what? I should eat more, to be perfectly honest, because they say, a portion of an early morning protein diet, they're sort of irreplaceable, aren't they? I just find them a little bit over-engineered. In other words, I have to put too much effort into creating them, and as a result, I don't tend to eat enough. But I probably should.
They're not a paid sponsor of the show, but I'm a big fan of Just Egg, which is a plant-based. That's also probably a pea protein source, like we talked about last week. Just Egg, very little preparation, right out of the bottle. And I believe you can get a bottle of Just Egg at most grocery stores right now, cheaper than you can for regular eggs. So that's my pitch for you. Very easy start to finish. You don't have to worry about cracked shells or anything like that. So this next part is interesting to me because I know that you have thoughts. And it's that 6 Fed officials are set to speak this week. How closely will markets be watching these comments? But more directly for you, Mr. Baccardax, should markets be watching those comments? Should we care?
We're going to have to care, unfortunately, whether we like it or not, because they do have such an influence on near-term sentiment. Now, if you're just someone who is invested, you're someone who's in an index fund, an ETF, or something of that nature, which has a longer-term return horizon, you probably don't need to pay too much attention to these Fed voices over the coming weeks because they aren't going to have a great deal of influence on those longer-term projections. What they are going to do, however, is change and potentially change very significantly the way the markets are going to react in the shortest term. So if you're somebody who's invested, it's not so important. If you are trading, it's extremely important. And this is just essentially the market that we have to bear at the moment. I think The most important indication that we're going to get from speakers this week, I haven't seen the list, but I assumed it does not include Mester and Bullard, the Cleveland and St. Louis Fed president, respectively. Those two policymakers were in the field last week advancing the case for the 50 basis point rate hike. But importantly, they are not voting members this year as a result of the way that the Fed rotates around which regional governors will vote in any given meeting. So we need to understand what the voting members have to say about the potential for these larger rate hikes. And if they tamp those expectations down, the market may be able to settle in to their current forecast of 3 more rate hikes, topping out somewhere around 5.5% in early July.
So we've got a 24.7% chance, according to CME Group's FedWatch, of 50 bips. What could happen between now and that meeting to increase that number? Obviously, we just got through PCE data. We got through a few other hot prints. Could more hot prints be on the way to jostle that number even higher, I wonder?
I think there's a lot of expectation, I guess, if you will, JD, that the January numbers, both in terms of inflation and in terms of employment, won't be sustained through the month of February, simply because January had that bizarrely warm period, which really ignited a great deal of economic activity, a great deal of hiring, and a whole lot of construction. Now, all that said, weekly jobless claims for the month of February have been trending down. Will that translate into a hotter than expected reading for February jobs? We won't know until the 10th because the non-farm payroll report is delayed until that time. So we'll get non-farm payrolls on the 10th, and then a few days after that, we'll get the first reading, the CPI reading, for the month of February. And then both of those will flow into I think it's March 23rd, interest rate decision from the Fed. So if there is a bigger than expected gain in jobs on the 10th of March, and then faster than expected inflation for the month of February a few days later, then absolutely there's the elevated chance of a 50 basis point rate hike. I still don't think they're going to go that way. I still think they would prefer to keep their powder dry with smaller increments and stretching it out over a longer period of time. But again, nonetheless, a 50 basis point hike would have to be respected if you had that bigger than expected job gain and faster than expected inflation reading, because it simply couldn't be denied that the economy is growing faster than anyone anticipated, and inflationary pressures are bubbling up as a result.
General FedWatch question for the fellow Fed watchers out there. Is it easier for the non-voting members, the Bullards and the Mesters of the world, to sound off on their potential support for 50 basis points because they're non-voting members?
That's a great question. I'd have to give some thought to that, JD, but I think it's a really interesting perspective. You might consider, as a policymaker, that you're freed up a little bit in order to maybe express some of the less popular views if you aren't deemed responsible to follow them up with a vote. I can see some argument for that. What I would say, and I always like to parallel what happens with the Fed to the European Central Bank, where minutes of their rate meetings aren't published in the same way. They deliver what are called accounts of the discussions for interest rate meetings. And as a result, they don't name policymakers by name. They just give vague descriptions of a few, some, one or two, various things like that. The reason they do that, JD, is they don't want policymakers in different member states to be sort of targeted as making decisions that are only for that member state, let's say, for instance, Italy, as opposed to the good of the whole of the European Union. Now, it's different here in the United States, where obviously the views of Fed officials are made known through public statements, but not necessarily identified in the minutes, although most of us can draw the conclusion by what public statements were made and what followed in the minutes description. And very often, the policymakers for the Fed will identify themselves as saying, yes, that was me making the 50 basis point rate argument at the last meeting. So I would say, having not given this question a great deal of reflection, I would probably say no, there isn't a larger degree of freedom as a result of not being able to vote, because the members still sit in amongst the discussions and try to influence their colleagues in a general direction. And I think other colleagues would see their making statements without the responsibility of voting as maybe a bit irresponsible. And that, of course, wouldn't be good for anybody in that collective decision-making process.
I assure you, my friend, my goal here was not to trip you up, but you genuinely don't know what questions I don't know what questions I'm going to ask you, because sure, we pre-write some questions, but then I just sit there in the moment and I think, oh, that's a question I'm going to ask. So certainly not my intention. But listen, it's an interesting point, because those are the members that have, I mean, they make headlines. I mean, even if you're a non-voting member, you throw out 50 out there, you're going to make headlines. And I, kind of coming from the world of politics, I know that there are freedoms that can come about if you're, for instance, no longer running for Congress, but you're still a member of Congress, right? If you said, I'm not running for re-election, suddenly you kind of come out and you kind of, maybe throw a little shade at your own party from time to time. You express your frustrations over things. You don't have to worry about playing the game anymore. Your job is done. And so that exists in Washington. And I just kind of wonder if some logic could be applied there to the Loretta Mesters of the world. We'll follow it closely. Okay, you want to talk earnings? You ready for earnings?
Let's do it.
26 S&P 500 companies set to report this week alone. Some of the biggest names you will be watching, Mr. Baccardax.
Yeah, I think Target tomorrow is probably going to be the most important. I think Salesforce is also going to be interesting. Lowe's as well. We can start with Target, and really I think what we are looking for, JD, is whether or not this company sort of echoes the similar caution that we heard from Home Depot and Walmart with respect to consumer spending heading into February and indeed into March and beyond. Target has had more of an issue as well managing its inventory properly. Walmart got ahead of the game and was able to establish a sort of, a better balance through the holiday season. And as a result, they have better than expected earnings, but a muted outlook. What we'll have to hear from Target is whether they were able to manage a bit of a stumble in the autumn with regards to inventory levels, and whether or not that translated into deeper holiday markdowns, compressed margins, and ultimately delivered less than expected profits. But I think ultimately traders are going to focus on the outlook, and that's what's going to move the stock rather than the headline number that we get very early on Tuesday morning. It's a very similar situation with Lowe's. In both Target and Lowe's, the case, of course, is that Target is the little brother to Walmart. Lowe's is the little brother to Home Depot. So we're going to focus on much of the same dynamics and metrics, just perhaps at a smaller scale. I think Salesforce, which I believe is Thursday, JD, will be interesting because there's now so much pressure coming from activists. I think there are 5 different activist names in the Salesforce stock right now. And the suggestion is that Mark Benioff's tenure as CEO might be at risk. And he was only named standalone CEO just a few weeks ago. I think investors want to see a bit more bit more clarity with regards to the path to profitability for that company, which has stumbled a little bit over the past 4 or 5 months. So I would say those are the 3 names that are probably going to be the most significant. Best Buy, maybe I could throw into the mix as well.
How crucial are any of these earnings names when gauging the overall health of the economy? And a name that also jumps out to me you did not mention, you don't have to address it, is Dollar Tree. And in terms of a company that might be really representative of where many Americans, especially in so many communities across this country, coast to coast, may have to go for basic necessities. I wonder what any of these numbers might tell us about where things stand before we really get into the print of those numbers that you talked about that the Fed will watch very closely between now and this time 4 weeks from now.
It's an interesting point, isn't it? I think consumer spending and, sort of like the consumer discretionary aspect of the U.S. economy, at least in the first quarter of this year, from the data that we know, is reasonably robust. And therefore, that doesn't necessarily translate to positive outlooks that would come from some of the discount retailers such as Dollar Tree or Dollar General or the others. But nonetheless, you're absolutely right. There has been a trend of trading down from consumers, particularly over the holiday season, as a result of elevated inflation. And if the Fed can't get its arms around that, you could see consumers retreating to those discount retailers in the near term in order to save money if inflation were to tick back up. But I think at the moment, there's decent resilience from a spending point of view that might not necessarily translate into a robust outlook for Dollar Tree, but we'll have to see. The food price inflation is probably the wild card in all that, and we simply don't know where that's headed. And ultimately, it is not impacted by Fed interest rates at all. So that may end up being the one aspect of all of this that we simply cannot predict, and could filter through into exactly what you're describing, that trade down to discount items as a result of the pullback in discretionary spending.
Yeah. Over 80% of S&P companies have reported so far. Earnings beats are at a 15-year low. Earnings season shaping up worse than you anticipated, still better, somewhere in between. What do we think so far?
It eroded from the beginning of the quarter, but then sort of flatlined, I guess, if you will. It didn't get any worse. I think I looked back, in fact, just this morning, JD, at earnings prospects prior to the Fed rate hike. Prior to the jobs data release on February 3rd and today, and it's virtually the same. I think we're looking at, I think it's a 3.2% decline for headline earnings. That number accelerates to about 7.9% when you take away the energy sector. And we're going to see somewhere in the region of a 4 to 5% decline in earnings for the first quarter as well. Again, all of those numbers are largely the same as they were in the beginning of February. They weren't great in February, but they're not a lot worse right now. I think ultimately what investors are going to try to compute is to whether or not the resilient economy is going to translate into stronger earnings growth and potentially a stronger S&P 500 performance over the back half of the year. We may not know that for a good few weeks and indeed a good few months from now. But nonetheless, I think the fact that earnings haven't deteriorated completely is something the bulls can hold on to, at least for the moment.
We're hearing more and more talk of an earnings recession. That's when most companies report profits that fall year over year for 2 consecutive quarters. Help us better understand what this means, Martin, and whether we're actually seeing one right now.
Well, I think there's an excellent chance that we will see it, and it is absolutely filtering into a lot of stock market projections. Morgan Stanley mentioned that quite notably today in a client sort of report that suggests the S&P 500 is very vulnerable to a March pullback. Mike Wilson is a star analyst there, and he has actually called the S&P 500 to fall more than 20% over the near term as a result of stocks simply being too expensive and investors being too bullish about the potential for earnings growth. He sees that potential earnings recession as maybe changing the minds of a lot of bullish investors, and as a result, we're going to see that sharp pullback. So it is absolutely important. Now, ultimately, there's nothing technical that we need to really understand about an earnings recession. It's just something that most of us can grasp in terms of a concept because it's similar to what we know about the economy. Even though, JD, we have talked at length about the fact that 2 consecutive quarters of negative GDP is not a recession, even if most of us consider it so, because a recession isn't defined until a much longer period of time in the future by the Bureau of Economic Analysis. So we can call it an earnings recession, but that doesn't mean that it necessarily is one. But that doesn't mean that 2 consecutive quarters of negative profitability isn't important. It certainly is, and it's absolutely indicative of why we're seeing that wobble in U.S. stocks at the moment.
Yeah, that's right. That the NBER dating committee's been quiet. It's a sort of entity I feel like is quiet until it's not quiet, and then it's everywhere. And then everyone's like, oh yeah, well, we did hit a recession X number of months ago or a year ago or whatever it is. So we still don't talk about it a lot right now, but there could be the point at some point later this year or whenever at some point it's suddenly splattered front page news everywhere. But for now, those economists still get to live in general anonymity. Yeah, what do you think there, yeah?
No, I'm glad you mentioned that, JD. I think I misidentified who ultimately defines recession. NEBR, of course, is the men and women that do so.
No, I think you got it right. I was just adding the dating committee component. Well, this is also a kind of a funny name. People hear it and think it means one thing, but that's what it is. Okay, time now for our rapid fire section because it's already 10:59. The show flies by when we're having fun and talking monetary policy. First up, let's talk the Oracle. Warren Buffett bullish on America after reporting record profits. What do we know here? Also, did you read the letter Saturday?
I did. I read a good portion of the letter. I thought it was interesting, and particularly in the context of something that occurred $6 billion in the fourth quarter and about $8 billion in stock over the whole of last year. And that, of course, was at a time where operating profits hit a record of $30.8 billion. Now, Mr. Buffett was extremely bullish on potential for economic growth, at least in the very long term, for the U.S. economy. But buying back stock is not necessarily an indication of that bullishness. If you do see the potential for earnings growth as a result of a stronger economy, you don't buy back stock at the same time. You put that money to use in the real economy, not by placating investors with repurchases. So I did feel there was some contradiction there, but that doesn't mean that I'm against buybacks in general. I still think they're a useful tool from a corporate point of view. But in my mind, JD, they represent a lack of imagination rather than some sort of particular skill in market timing.
All right, interesting. Well, point well taken. All right, number two, the CEO of Union Pacific stepped down. This whole thing happened pretty quickly this weekend. What's going on here?
It really did. I mean, the company is Soroban Capital. They've been talking with Union Pacific, I think, since 2017, have been complaining about profitability and stock performance over a long period of time. So the result over the weekend, I think, was probably a cumulative action rather than one that just came out of the blue. But nonetheless, it was absolutely quick and a lot quicker than people expected. Lance Fritz is going to step down. The committee is already in place to try and find a replacement. And as a result, we're probably going to see a new CEO at this very important rail group in the coming months. But it's interesting, JD, how much success activists are having in putting potentially new people in CEO positions. We've seen it at Disney, we're seeing it now at Union Pacific, and we may see it at Salesforce also. So I think any CEO now who's in a position where they are underperforming and they are coming up against new investors who are less patient than some of the very long-term capital providers, they need to be wary.
All right, number three, Pfizer is in talks to acquire Seagen in a massive deal. What are the details there?
This is an interesting one. The Wall Street Journal reported this morning that the companies are in early stage talks. Seagen, which basically sort of specializes in very specific and targeted cancer treatments as a result of some really interesting technology in the oncology space of the healthcare sector, is worth about $30 billion. So any premium on top of that could carry a price tag upwards of 40 and perhaps 50 billion. It would be a terrific add-on for Pfizer because Seagen's oncology revenues are not that far off of Pfizer's oncology revenues, which are mostly led by its breast cancer treatment called Ibrance. And Pfizer is also going to see about 17 billion in revenues fall as their certain treatments, not just in cancer, but in other areas, come off patent over the coming years. So Pfizer does need to execute a big deal. This would fit very nicely, and I think that's why we're seeing the stock bounce so significantly this morning. Seagen, I think, was up about 15% as I last checked, and Pfizer was about 1.5% lower as a result of maybe some dilutive aspects of what people think they're going to use to pay for the group a portion of cash and stock. But I suspect this one is going to get done. Merck was associated with Seagen last year. I don't think Pfizer's going to miss. I think they're going to pull the trigger on this one.
All right, fourth and finally, more job cuts at Twitter. What do we know?
Another 200 have gone over the weekend, according to the New York Times. That's about 10% of current staffing levels. There were around 8,000 people working for this company back in October. That's not a long time ago. We're down to about 22 or 2,100 if the numbers from the weekend prove to be correct. And one of the high-profile people that looks to have been left out, JD, and was let go over the weekend was an employee who went viral back in the fall as she was sleeping on the company floor at the behest of Elon Musk, working triple and all sorts of crazy shifts in order to keep the social media network afloat. The reward for that is you're sacked in February. This is going to be a difficult series of job cuts for Elon Musk to manage, because this, at the end of the day, even if it's a tech company, it relies on a significant amount of man and woman power to keep it going. And when you slash it to the bone, as he is doing, vulnerabilities are inevitable. And I think this one takes, it requires some very close scrutiny.
Yeah, it absolutely is, and it's something we will continue to follow and scrutinize very closely. The great Martin Baccardax, no shortage of busy topics, whatever we have you on, man. Thanks for making us smarter together. Have a great day, Martin.
Thanks, JD.
You got it, man. We'll do it again soon. That is going to do it for The Street today here, my friends. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.